Hey, welcome back everybody. Now today let's talk about stock prices and go beyond what is easily seen in a stock quote. For example, how can Disney, a $113.07 stock, be cheaper than WWE, a $21.83 stock? Well, the secret is the float, which is just a fancy inside Wall Street term for the number of shares issued by a company that can be owned by the public, people like me and you. It is quite simply the supply of stock shares. See, I told you everything comes back to supply and demand. Now, the size of a float varies quite a bit from stock to stock. So in order to compare apples to apples, traditionally the financial media use the classic price to earnings ratio, often called a PE ratio for short, and it's also often referred to as a multiple. These terms might sound esoteric, but it's really just simple arithmetic. You divide the price of a stock, Disney's $113.07, by its earnings, a legally reported $5.54 during the previous fiscal year, and you get a PE ratio or multiple of 20:41. In other words, whomever bought the Disney shares for $113.07 is paying about 20 times the dollar amount of the company's previously reported earnings per share. Hence the term multiple. On the other hand, WWE's $21.83 divided by its 44 cents of earnings per share gives you a multiple of $49.99, or as I like to call it, $9.99. So at least by that simple metric, WWE is about 2.5 times more expensive than Disney. Now don't focus on the specific numbers I've just spat out, focus on the larger point. You can't compare stocks based on share price. Far too many people erroneously believe that a $2 stock has a much better chance of going higher than a $1,000 stock. Often it's quite the opposite. But companies are aware of this psychological phenomenon, so you'll notice there aren't very many companies over the $1,000 threshold. Naturally, companies want to keep growing their earnings and thus their share prices, so instead of hamstringing themselves, they perform a stock split in order to make this share price more psychologically appealing. 10-for-1 stock splits are fairly common, meaning instead of having 10 shares of a company trading around $100, one day you'll wake up and get 100 shares of a company trading around $10. The earnings per share is a different ratio, but you don't have more total earnings. Let's put it another way. You make a personal pan pizza and cut it into 4 slices. But you're famished and actually want more pizza, so you cut it again, making 8 slices. But clearly you don't have more pizza, you just have more slices. The same is true of a stock split. Now before we get out of here, one final note that will transition us to the next video. The PE ratio / multiples I used here were taken off Google Finance. Notice that these numbers are from the previous fiscal year's earnings. But no one buys a stock based on past performance. No, we want growth in the future. More on that topic next time. See you there.